Hello everyone, this is Tim Leveroni. Joining me today is Lee Generous. We want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of the investment managers we recommend. Shortly I will introduce our speaker, Jeffrey Bookbinder. He will present LPL Financial's outlook on the current markets, interest rates, tariffs, and address concerns of a recession. This call is being recorded today. There will be no questions during the call. If you have any questions, please call or email us. Jeff Bookbinder is Vice President, Equity Strategist, and Portfolio Manager of the LPL Financial Research Investment Management Committee. Okay, Jeff, take it away.
Great. Thanks so much, Tim. Appreciate the opportunity to talk to you today and give a market update when the market's doing pretty well. You mentioned recession concerns. The stock market is actually a pretty good predictor of recessions. So is the bond market, or specifically the credit markets. And we're certainly not getting too much in the way of recession signals these days, which is great. So I'm going to talk about the mid-year outlook that the LPL Research Department just put out here a couple weeks ago. The theme is fundamentals. This was the theme for the full year outlook that we put out last fall. And we thought we'd stick with it because, frankly, the transition to a market driven by fundamentals has been a little bit slower than we would like. So it's been a good environment for markets, right? We've had folks expecting the Federal Reserve to cut interest rates. That has helped market sentiment. Some have expected progress in terms of trade with China. That seems to have, in general, helped markets here in recent months. And along with that, we've had generally investors get more comfortable that we will not have a recession anytime soon. So with a great first half, stocks up almost 20% in the first half, and now even adding to those gains here so far in July. Our outlook is divided into 4 sections, so I'm going to cover those with you today. First, policy. Second, the economy. Third, fixed income. And fourth, equities. So if we go into the first slide here, and that's on stimulus. So fiscal stimulus is actually, it's an important distinction to make. Fiscal stimulus is really what Congress can do to juice the economy. And part of that is just the government spending more money. At the same time, certainly Congress, they have to get approval from the president, but Congress can also cut taxes. And we know that that's indeed what Congress did a couple of years ago. So what this chart shows is the incremental impact of fiscal stimulus as a percent of the overall economy. So you may have heard folks say the tax cuts have created a sugar high, and that's wearing off. Well, the math doesn't really support that. We do see a little bit of a slowdown, certainly in terms of the incremental benefit from stimulus in 2020, but that actually is primarily driven by defense spending cuts that probably won't happen. If you look at the 2018 bar, tax cuts added about 1.3% plus government spending, added about 1.3% to the economy. 2019, it's expected to add about 2.2%. So the incremental benefit, essentially from what Congress is doing to support the economy, is actually bigger this year than it was last year. Now, why are we not seeing this in the economic data, or at least not consistently? It's because of the uncertainty around trade. So essentially, tariffs and trade uncertainty, which have curbed investment, have eliminated this benefit, and basically the economy is growing at 2% trend this quarter, and probably will continue to grow at the long-term trend for the next several quarters until we get some sort of progress on trade. So the next slide, you see the twin deficit. So a lot of our clients are concerned about the debt and the deficit, right? The debt is the big pile of debt. The deficit is sort of how it changes over time. We also show the trade deficit here. Now, the reason that we care about this as investors right now is because as these deficits widen, there's the potential for not only inflation, which can create dollar weakness, but also there's a possibility that at some point, buyers of U.S. Treasuries will question the solvency of the U.S. essentially as a borrower. Now that sounds pretty dramatic. There are obviously a lot of gradations of credit quality, but at some point, if we don't do anything to address this debt and we continue to run these big deficits year after year, eventually the market is going to question whether we're going to pay it back. And so you might see not only a little more inflation, but you might also see higher interest rates. So even though interest rates are falling, and the Federal Reserve is almost certainly going to cut rates probably in just a couple weeks, you also have a situation where there's upward pressure on interest rates potentially from these deficits and downward pressure on the dollar. So that's a really important long-term challenge that we have to monitor. So if we go to the next slide, our economic forecasts.
So Jeff, there seems to be, this is Lee speaking, there seems to be a consensus from portfolio managers and economists that we speak to that global economies, as the slide shows, are going to outperform U.S. economies on a percentage basis. Can you share with us and the audience, LPL's perspectives on that?
Sure. Yeah. Well, it's really important here to make the distinction between developed markets, which is really the U.S., Europe, and Japan, and then emerging markets, which is really China and even smaller economies throughout Asia and Latin America. So if you look at developed economies, we're seeing much slower growth. Now, U.S. is probably going to be one of the best, if not the best, in terms of economic growth. And part of the reason is because, as I mentioned, fiscal stimulus is supportive. I also mentioned that the Federal Reserve is probably going to cut rates. That's going to be supportive as well of the economy. That's monetary policy. So, and frankly, we're one of the most productive economies, which I'll get to in a minute. So those factors combined set the U.S. up to grow faster, certainly, than Europe and Japan. Europe and Japan also have some challenges in terms of political uncertainty. I'm sure you've heard about Brexit in the UK. Japan has a tax hike coming on the books in just a few months. These areas of the world have demographic challenges that are even worse than the US. So there's a number of challenges in Europe and Japan that allow the US to grow faster. Now, those challenges aren't really present in the emerging markets. I'm largely talking about China and Southeast Asia. China's biggest challenge right now is U.S. tariffs. However, they have a lot of control over the economy, and they are putting in a lot of stimulus right now to support growth. The latest round of data in China has been actually pretty good, showing that that stimulus is having some positive impact in helping offset the negative impact from less trade with the U.S. So China's hanging in there quite well and is growing at north of 6%. If you take all the emerging markets.
But Jeff, is that stimulus China's been doing mostly fiscal stimulus by their government or monetary stimulus by their banking systems?
Well, it's a good question. It's both. They've actually done some tax cuts, but the biggest piece of their stimulus lately has been cutting the reserve requirements so that banks have more capital to lend. So it's really fiscal stimulus more than monetary, but certainly they've been supporting their financial markets and supporting an orderly decline in their currency via the People's Bank of China, the China version of the Fed. And by the way, they have a lot more they can do. They've done some infrastructure spending too. So you got a really good shot here at getting roughly 4.5% GDP growth in the emerging markets. China is certainly a big piece of that. And at that pace, you're more than doubling what you're getting in the developed world. So we like the idea of investing in those emerging markets because of that better growth. You don't always get a close tie between economic growth and market performance, but over time with emerging markets, that connection actually is fairly close, fairly tight. So we expect improving growth in emerging markets relative to developed markets to actually support investing in emerging markets. So that's the key takeaway here. So if we go to the next slide, I mentioned productivity. This is essentially how much companies can make per input, right? So, if you've got an economy at full employment, meaning there's no more workers you can hire, in theory, how are you going to get more output? How are you going to make more widgets? Well, the only way to do it is to get more productivity, which means you got to make more with the people that you have. You have to use software. You have to use robots, right? You have to use high-tech equipment. So, this is starting to happen, and you can actually see in this chart in the first quarter, we got a little bit of a productivity boom. In other words, companies doing more with less. And the reason this is important is because this business cycle is now 10 years old, right? The economy's been growing for 10 years. We hadn't had a recession since early '09. The way that most business cycles end and recessions begin is because inflation picks up and the Federal Reserve slams on the brakes with higher interest rates. But if you can generate more productivity, that means you don't have to overpay for workers and drive inflation higher. You can actually have more growth with less inflation. So this is really important to extend the business cycle, keep the Federal Reserve friendly, and generate economic growth. So we think this economic cycle has a good bit more to go. It's certainly really hard to predict whether it's going to last 2 more years, 3 more years, or 4 more years, or longer. But I'll just say, don't totally discount the possibility that there's several more years to go here, with trade being certainly the big risk at this point. So talk yield curve next. This is a really wonky kind of a topic that, maybe a year ago nobody had even heard of. And certainly, I'm sure many of you didn't even know what it was. It's gotten a lot more attention recently, so I think it's worth spending a little bit of time. So the yield curve is just the difference between short-term interest rates and long-term rates.
So Jeff, this is a topic that we tackle in a lot of our client meetings. And I think outside of the finance geeks in our office and over at LPL Research, I think a lot of people don't fully comprehend what the inverted yield curve is. Can we just give I guess for the novice investor, a simplified explanation of what it means when the yield curve inverts or the yield curve flattens?
Yeah, absolutely. So it is, it's a bit of a complex topic, so I'll try to keep it simple. So the first, the yield curve is just short-term rates versus long-term rates. And that you could think of as a money market rate, or the rate you get on your savings in a bank account, compared to the rate you might pay for a mortgage or maybe even an auto loan. Certainly those are longer term rates. And so the way this is supposed to work is that you're, as a lender, you're supposed to get more the longer you're willing to extend the loan. But when this is inverted, when the curve is inverted and you actually get less for a long-term loan, the message there is the market is pricing in a higher chance of recession, and the market is saying that the Federal Reserve is too tight, which means short-term rates are too high. So this is what's happening today. The bond market essentially protested where the Fed was. And based on this inverted yield curve, the market was telling the Federal Reserve, your short rates are too high for this economic environment. Now that the Fed is expected to lower short-term rates, and the market is getting more comfortable with the economic outlook, that is essentially normalizing the curve. So we've had some steepening, short rates falling, long rates have kind of held in there, even risen a little bit over the last week or so, and you end up with a more normal curve. Now, only parts of the curve are inverted, which means this isn't quite as scary as it might otherwise be. And the curve has to stay inverted for several months to be a really powerful recession signal. And that has not been the case as of yet. And by the way, we had some periods in the late 90s with flat and inverted curves where the stock market did really, really well, and the Fed did a U-turn just like they're doing now.
What do we generally look at, Jeff, for specifically to see inversion? Which parts of the interest rate environment?
Yeah, well, we like the 2-year Treasury as the short rate versus the 10-year, because the really short-term rates, the 3-month or 90-day T-bill, which a lot of people also use, is so influenced by the Fed because it's just very short-term. And frankly, our analysis showed that the 2s, 10s was a more effective signal anyway. It's basically a more dramatic inversion. And when you get that more dramatic inversion, that's when you have a higher chance of recession. So we would watch the 2-year, 10-year most closely, but certainly we know a lot of people watch the 3-month, 10-year, so we pay attention to that as well. And frankly, that's why we put it in here.
I know we've had some recent commentary from LPL and some research articles, but just because the curve it does invert doesn't necessarily mean recession's coming today.
That's right. There is a big lag. In fact, if you do believe in this as a recession signal this time, history still shows that the stock market goes up for another year and you got some lag. So the message here is, even if you're really skeptical, we wouldn't run out and buy and sell stocks right here. And certainly, the other reason, this is the next slide, the other reason that we don't think this is a recession signal is because credit spreads are tight. So a credit spread is just the difference between the yield on a corporate bond and the yield on a treasury. So the difference between those two yields is basically the premium that you get paid to lend to a company, which is riskier than lending to the U.S. government. Right? Makes sense that companies would be a bigger credit risk, or consumers would be a bigger credit risk than the government, right? So if the market was saying recession's coming, and if market agreed with the yield curve that recession risk was rising, then we think we would see widening credit spreads. And corporate bonds, both investment grade corporate bonds and high yield corporate bonds, are behaving very, very well. So this is another reason why we don't think we're going to get a recession anytime soon. Frankly, it might be 2-3 years away or more.
Now, I see we're going to hit on some of the different types of fixed income and, LPL Research's views on them. One thing I don't see on the upcoming slide is municipal bonds, and I know that we have a number of clients who are invested in municipal bonds. As we go through the views on fixed income, can you add some insight into that space as well?
Yeah, absolutely. We generally are fine with municipal bonds. It's just not one of the major fixed income sectors that we always highlight in these tables. I think part of the reason is because it's just such a great idea for tax aware investors that we just we basically recommend people put all of their fixed income, if they're really tax sensitive, maybe not all, but most of their fixed income allocations in municipal bonds. And there are different flavors of municipal bonds, different terms, short, intermediate, long, and then there's high yield municipals too that are a little bit more risky and offer a little bit higher yield. So there's different flavors of municipal bonds, and certainly we think make great sense in taxable accounts where investors are more tax sensitive. The yields are low, just like they are in treasuries, but when you factor in the tax benefit, you're doing pretty well relative to other high quality taxable bonds. So, you got to think, I'm sure Lee and Tim have talked to you about this. You got to be sure to understand what a taxable equivalent yield is when you look at a yield on a municipal bond. It's really higher than it looks based on the tax rate that you pay.
Right. Federal. If you don't have to pay the federal tax on those municipal bonds, it does can make a world of difference.
Oh yes, huge difference. In fact, we've created a benchmark for our tax-aware portfolios that we manage here internally, and we just have all munis in there. So that tells you how we're trying to cater to those tax-sensitive investors who are certainly in the high tax brackets. So, and also municipal bonds are very high-quality bonds with very low default rates. So certainly these municipalities in general are going to pay back what they borrow. So, that's really where we want to be focused. So you can see here in this table, the overweights, the areas where we want more exposure, investment-grade corporate bonds and mortgage-backed securities. Those are both high-quality bond sectors where the odds that we get paid back and get our principal and our yield, our coupon, are really high, especially in mortgage-backed, because those have an implicit backing from the U.S. government. These are, Fannie and Freddie agency mortgage-backed securities. So really high quality, and that's why you get lower yields. But we like kind of a barbell, so we're sort of pairing that with a little bit of higher risk types of fixed income. So we've got a little bit of, high yield sprinkled into accounts where we think they're more tolerant of risk, and a little bit of emerging market debt in certain places, again, to just juice yield and take a little bit of risk. But by and large, and you can just see it in this table, we want to be high quality with our bond allocations because we want that to diversify our equity holdings, right? When the stock market drops, and we think it will at some point, although maybe people are forgetting that the stock market does drop because it's been a straight line up for the most part this year, except for May. Eventually it'll drop, and we will want those bonds to provide some cushion against the stock market declines. So that's why we like the idea of having our fixed income be high quality, even though we have a pretty positive economic growth outlook for not just the U.S. but globally. So that's just a quick overview of how we're investing in the bond market. Now, my title is equity strategist, so I like talking about equities more, but the My boss put these together, our chief strategist, John Lynch, and he likes to go with fixed income first. So who am I to go against the boss? So let's talk stocks. So we're having a great year. I mentioned it up front, right? And we all know that stocks don't go up in a straight line, and pullbacks happen. So we think there's a good chance we get a pullback. Hopefully it'll just be something like what we had in May, call it a 5 to 7% pullback, but there's a reasonable possibility that we get something bigger. However, based on the market fundamentals, our outlook on the economy, and all the data we look at, we think the odds are good that dips will be bought. So if we get one of these pullbacks, we think it's going to snap right back, and that's frankly what's been happening this entire bull market. Now, there are risks, so you might ask what could drive the pullback. Well, the obvious one is an escalation of trade tensions with China. Certainly, we've seen that create volatility already this year. The market's hopes are, again, getting higher and higher that we'll get a trade deal. And it might be a little bit harder than the market thinks. We might get a partial deal. We might get another truce. Maybe this deal doesn't happen in the fall. Maybe it slips into next year. There are a lot of question marks here. So we're watching this very carefully, but we recognize this could create some volatility. Now, the risk that we would have said was a big one a few months ago is not as big of a risk, and that's that the Federal Reserve has rates too high. And we saw in December and a little bit earlier this year what can happen when the market doesn't like what the Fed is doing. But now the market likes what the Fed's doing, right? The Fed has done this complete U-turn and is, not only the bond market's basically pricing in more than 2 rate cuts right now this year, which is really aggressive. I don't think the market could reasonably expect anything more than that. Maybe we get that, maybe we don't. But my point is, the market is pleased with where the Fed is at right now, and the odds of a central bank policy mistake are quite low. So beyond that, you've always got risk that some geopolitical event could spook markets, but right now we're quite comfortable staying invested in equities. Another reason maybe some folks are not as excited about the stock market is valuations, but we actually think they're quite reasonable. Earnings are still growing, inflation's low, interest rates are low. That is a great environment for stocks. And so, you might have seen the price to earnings ratio quoted as a measure of stock valuations. So the price to earnings ratio on the S&P right now is only about 17.5. That's quite reasonable, and we think for the current environment, it might even be a little bit cheap.
So what does that mean, Jeff, to the average person, that 17.5 number? Where does that number come from?
Yeah, good question. So the level of the index is the price. So basically the PE measures how much investors are paying per dollar of earnings, right? So if the S&P 500 is going to generate $170 in earnings this year, which is our forecast, and it's trading at around 3,000, that's the index price. You just divide 3,000 by that 170, and you get around 17.5. So if the market is worried about recession, it'll pay less per dollar of earnings. And if the market is, too bullish, euphoric, then you'll get 19.99, and you'll have the market paying too much for earnings, which is what happened back then. Back then we had a PE of 30. So 17.5 is, we think, quite reasonable for this economic environment. Now, some people calculate a PE based on 5 years of earnings or 10 years of earnings. We don't like to go back that far because things were different back then. So if you do last year's earnings or maybe 2 years of earnings or next year's earnings, all those types of valuation measures we think suggest stocks are fairly valued. So I hope that's helpful perspective. So in terms of what we like and what we don't like within equities, that's what this chart's supposed to illustrate. So Lee, did you want to highlight anything on this topic?
Yeah, I know that when we look through this, and again, more geared towards some of the novice investors out there, maybe just help elaborate and define for those people, what is a large cap stock versus a small cap stock, and from a style perspective, what is growth versus value? Because these are recurring themes throughout the market and economic cycle. I just want to make sure that people understand exactly why we're looking at these different capitalizations and these styles and how they come into play during the different cycles.
Yeah, I actually talked to some clients last week, and I was asked to define emerging markets and developed markets. I wasn't really ready for that. I don't think I gave the best answer, but I guess per capita GDP is one way to do it, or even just wealth per capita, right? I mean, these are, like, Japan was an emerging market coming out of World War II, and now it's developed. It's a quality of life kind of a measure, I guess. So, emerging markets certainly are more rural economies, certainly they have less sophisticated financial markets and capital markets. They're not as trustworthy generally as places to invest, so you got to be a little more careful. We've seen Venezuela, for example, an emerging market that's been in crisis for quite some time, and certainly none of us should trust giving our money to Venezuela at this point. That's an extreme example, very extreme, but and nothing like the China situation. But emerging markets tend not to be as reliable places to invest. So that's maybe another way you can define developed markets versus emerging markets. In terms of market cap, it's just the size of essentially the dollars invested in the company, right? The ownership of Apple is, for example, split between institutions and individual investors. If you add up all the stock that all those individual investors own and all the stock that those institutions own, you're going to get 900 billion plus, and the employees, by the way, I guess, and that's the company itself owns some stock. That's in total your market cap. That's your equity market cap. So companies that have 10 billion plus, give or take, tend to be large cap. A lot of different index providers define these breakpoints differently, but we'll just say roughly 10 billion plus is a large. 2 to 10 generally is mid, and then 2 billion and under generally is small. Actually, those breakpoints are probably a little bit low given the bull market we've had, because you want to have the mix of large, mid, and small remain roughly the same. But it's just the size of the company's invested base. That's really all that means. And later in the economic cycle, we've been growing now. This economy has been growing for 10 years. Larger cap companies tend to do better. Coming out of recession, that's really the best time to invest in small caps. I mean, that might be oversimplifying it, but that's probably the most important playbook to remember. Later in a cycle, when markets and the economy become more uncertain, you want the stronger balance sheets, the bigger, more reliable earning streams from the larger companies. And then lastly, growth value. The way most investment firms break up growth and value is by valuation. So if a stock is expensive relative to its earnings or relative to its assets, it's growth. And if a stock is cheap relative to its earnings or relative to its assets, it's the value company. But some define in a little bit more sophisticated way and actually look at growth rates, either the earnings growth rate for the company or the revenue growth rate for the company, factor that in. So the companies that grow the fastest and have the highest valuations tend to be your growth stocks. So examples of, Amazon, Facebook, Google, right? Those are your typical growth type companies. And then value would be the slower growing companies, like the big utilities or maybe the big banks, big energy companies, the Exxons and Chevrons of the world. These are more value names because they trade cheap, typically, relative to their earnings or assets, and they don't grow as fast. So that's the delineation. Now, right now, we're not necessarily recommending people, go way over to one side of the boat or the other. Generally, we think it makes sense to be a little bit more in value stocks right now because growth stocks have been leading for over a decade. It's one of the longest and most powerful rallies in growth stocks that we've ever seen. So we want to be a little careful with that. So we're not, so we're not overweight growth. We're slightly overweight value. And then I mentioned that we like investing in emerging markets, but again, I highlighted the risks. We have a very modest amount of emerging market equities relative to our recommended equity allocations. And then on market cap, we're mostly large cap, but relative to benchmarks, we do have roughly an equal amount of small caps as well. That just ends up being a really small weight. In our total stock market benchmark, small caps are less than 10%. So a really small weight, and we would suggest folks keep those small cap allocations pretty modest within their equity portion of their portfolios. So that's how we're recommending folks invest in equities, not major bets here, just some tilts, and overall we're market weight. So if you're using a 60-40 benchmark, that's how we recommend you invest, roughly 60-40. So that's all I had in terms of prepared comments on the mid-year outlook and on how we're recommending folks invest. So Lee or Tim, do you have any other questions on any of that content, or can I just give my quick commercial?
No, that was great, Jeff. We appreciate it. Great insight for our clients and for the general audience out there. We appreciate the help and the insight, and you can wrap it up with that.
Great. So yeah, so if folks are interested, I mean, obviously you're getting plenty of great investment insights from Tim and Lee and the team, but if you want to just go a little bit deeper, just want to point out that we do have videos on YouTube. We have a Twitter handle at LPL Research, and we actually have a podcast. So you can hear from us directly if you are interested in getting our insights regularly through any of those media. And then I promised our friends in compliance that I would spend a little time on these disclosures. So we're going to look at how many pages of disclosures do we have. I don't want to scare people. We have 3, right? So we're going to carefully look through these disclosures and make sure we digest every word. So with that, I'll hand it back over to you, Tim and Lee. Take it away.
Thank you, Jeff, for your thoughts on the current market environment. As a reminder, if you have any questions, please contact us by calling 781-848-9821 or visit us on the web at www.leveroni, that's LEVERONI.com. We also would like to hear some feedback from you to help us improve the format of these calls. Also, if you would like to share this information with anybody or know of anybody who would be interested in hearing our market update, you can forward this email to them. Thank you again for your continued confidence.